Ladies and gentlemen, welcome back to the Daily Capital Flows live stream. We've come to the end of the week. We've covered a lot of different things in the live stream this past week. If you're joining for the first time or just kind of getting your bearings, the amount of stuff that we've covered in the last week, covering Japan, covering equities, talking about hyperliquid, talking about PER, talking about Bitcoin. We've covered all of that. Now the macro picture is actually having a significant impact as we have the job reports this morning. And it is, if honestly, if you were in the live streams this past week, then the price action today does not surprise you at all. Because one of the things that I laid out is that, you're going to have little shocks in interest rates because why? A recession is not on the table. And it's actually pretty ironic that President Trump is even tweeting about this, where he basically says like, "Oh, interest rates shouldn't be going up. Growth is fine," right? Like, what's going on with the economy? And so today we had the non-farm payrolls come out, which indicated that the U.S. economy remains on very good footing. That reverberates across everything. And, again, if you were following everything that we're talking about, you think that, oh, well, most people who are not digging into and understand the mechanics of things will say, wait, growth just increased, but equities are selling off. How does that make sense? And it's not, oh, good news is bad news or something like that. It's that interest rates are the primary driver behind today's move. And that's the main thing that we're going to talk about. So I think that'll be a really important topic for today. And I'm going to pull up a chart of that starting everything. James, how are things going on your end?
Oh, just swimmingly. I just woke up and I just looked at TradingView this morning after I had a nice cup of coffee, and I said, don't I love America? This is exactly what I wanted to see. So, whatever. Things are fine. I have deployed a little bit more into certain areas that I like. Sometimes it feels gross, but like you said, these are scenarios we've planned for, thought about, and I don't really see the bigger picture changing here. Plus, honestly, I like seeing Trump tweet that because that makes me think the guy's looking. The guy really is starting to care with midterms coming up. And that just gives me a little bit more like, I don't know, support or whatever to keep betting, because I just think they're going to be throwing the kitchen sink at this as much as they possibly can. That's where my head's at.
Yeah. I think that today is a day where it is so clear why understanding macro liquidity and interest rates is so critical, and how it is interacting against the job market. Because the fact that growth is coming in above expectations, if you're going to say, oh, well, good news is bad news now, when good news comes out, it's causing equities to sell off. That is not really the case, because if good news was bad news, if, let's say, we just had a hotter job print and that's now the top in the job market and the job market's about to turn negative and go into a recession, then what would you see? You would actually see what? Stocks down and bonds up. But what are we actually seeing on the day? We're seeing ZT make a new low. We're seeing UB sell off a little bit. And the long end of the curve is still not really moving as much as people expect. I think that the driver of everything has been centered on the short end. And so, when you have equities down on the day, it's not surprising. Again, like not surprising at all to see us move back a little bit as you have interest rates tick up marginally. And this has been and again, if you understand this very well, if you've been on the streams every single day and you're not coming in and saying like, whoa, wait, what in the world is happening to today? We covered this, I believe it was yesterday, where we talked about, notice that we have had these moves where when vol begins to rise and bonds move down, notice it pulls back on the S&P a little bit, but stocks continue to outperform bonds. And so the idea is that, sure, these are causing momentary pullbacks, but these on net are likely to be buying opportunities. And so this continues to be my stance over and over. Are we at a little bit of a complacent point in equity positioning? Sure. Maybe we could pull back a little bit, a couple percent from all-time highs. I'll go over a chart really fast on that so that you can understand what's taking place and how to think about it. But the overall idea is that we are not seeing a regime where recession is the primary risk. And let me pull this up. Let's see if I can get this. There we go. So when we look at where we're at with just implied vol changes in the S&P, things like that, what we can see is that, here are just the basic vol metrics that we look at for the S&P 500. And I'll label these a little bit better for you guys, and I'll share this chart on the Substack later. But when you have these moments where complacency builds, you can kind of see, I need to label this better so that you guys can see this. The idea, let me pull it up really fast. Hang on one second. Because I'm just going to share this chart. Okay. There we go. So when we look at the S&P 500, there's a better chart of it so you can kind of see this. The positioning that we are seeing. So in red right here, you have 25 delta calls minus 25 delta puts. When this is moving up, it's an indication that calls are getting richer than puts. That means people are paying more for calls. They're paying a premium versus puts. And this typically rises and goes to extreme. It mean reverts as we move through these different periods of time with the S&P 500. So vol has come back down and we're at these lower levels. And, when you have vol compressed like this and we're a bit high and you have any type of macro vol begin to rise a little bit where rates and FX begin to shift a little bit, that's when you can say, okay, yeah, we can have a little bit of a pullback. But the question is, how much of a pullback can take place overall in the system? And the only way to know that is to understand the macro drivers that exist in the system right now. And if you get those, that will begin to make a lot more sense. And here is a breakdown. Let me make sure this is pulled up really fast. Everything's moving a little bit slower today. I'm not sure why. All right, we'll just go to trading view. When we have these macro drivers where rates begin to be the driver of what is taking place, then when the labor market data comes in above expectations, and you know that this is actually pricing higher inflation risk and more growth risk than it is on this side where equities are beginning to price a recession or something like that. And so you can see that, rates are down on the day. And this is a great example to understand how macro is impacting other asset classes. Notice right here, you have, bonds moving down. Notice as well on the day, we have this moving down with the NFP level now right here. So this NFP level is going to be important to watch. Again, here's the chart that we shared. Let's see if we can get this. Right here with non-farm payrolls, the labor market continues to be strong. Very similar to actually 2023, where it comes out above expectations. This has been my view for a while that rates are probably going to move up a bit. And at best, bonds are neutral. So being long bonds is not a great trade right here. And that continues to be the case. But notice, bonds are down on the day. Now, notice what this is doing to currencies. You have the dollar strengthening. I'll just pull up the DXY so people can kind of understand. You have the DXY strengthening a little bit. And this is ticking up a bit more. And this is beginning to reverberate across other things like gold and silver. We have gold and silver down on the day marginally. And so now what I know is that right here at this level, we had a positioning unwind right here where vol blew out. We talked about that the other day in the stream. And vol is much lower in gold and silver right now, but now we have this key level as it relates to interest rates. Interest rates rising are putting downward pressure on gold and silver. And so what I would want to look for is, if I wanted to get long gold and silver, is seeing gold and silver outperform bonds moving down. Because if bonds keep moving down, it's probably going to keep dragging gold down until gold rejects that kind of macro catalyst and that sensitivity to things. Now you can see Bitcoin being down on the day is also connected to this idea as well. The divergence is that, Bitcoin is not correlating fully with the equity market. However, the fact that we are down on the day right now and correlating with gold and silver shows that interest rates are having a negative impact on Bitcoin. And that if interest rates keep going up, it's probably going to continue to have a negative impact on Bitcoin from a macro basis. Could we have, positioning unwinds here or there? 100%, which is why you really want to frame every positioning unwind or move within the macro context, within the correlations that exist. So for a durable move to take place in Bitcoin to the upside, what we would need is a top in interest rates. That would be my view, especially since that's what's correlating the most. Now, go ahead. Sorry. Go ahead, James.
No, you're good. Yeah, no.
This brings us to the whole hyperliquid thesis and us understanding, okay, is hyperliquid going to start correlating with Bitcoin, or is it going to diverge? And what we have seen over the last several days is hyperliquid correlating with Bitcoin and also Zcash, as we have this risk in the system of, okay, well, what exactly is safe or not safe from this entire, Claude, analysis that can find vulnerabilities or things like that. And what I would say is, overall, what we need to see is the macro drivers for hyperliquid diverge. I'm sorry, the micro drivers support hyperliquid, and hyperliquid diverge from Bitcoin and things like Zcash. Because, when you have, the risk reward that I shared still remains intact. This level right here that we had in hyperliquid was when Coinbase began to inject more money. They began to really push, a lot more capital into the hyperliquid system. And let's see. I'm going to pull up this other chart that I just shared right here on Twitter. And you'll see that right now, Hyperliquid is still adding and still accelerating in the protocol fees every single day. So it's almost like Hyperliquid is getting more undervalued as it pulls back. That's a fundamental difference than something like Zcash, where everyone's wondering, well, what is the underlying cash flows? What's the underlying utility that is going to constrain the float? Whereas Hyperliquid, even though it's pulling back a little bit as people are kind of adjusting their exposure, the underlying cash flows are actually accelerating, which is almost like, buying a stock that is, becoming a little less value, or, it's getting a little undervalued. So sector flows are probably selling Hyperliquid a little bit. Everyone who, chased and bought the highs, they're getting flushed. But overall, the trend still remains kind of intact. And that's why I continue to just hold my longs. And that's why I think it's so important to, be on sides into major events like this. My view is that, Hyperliquid and Per are going to have a melt up within the next 60 days, especially as we get more clarity on the regulatory front. But with that being said, we've had a pretty significant rally, and we've mean reverted a little bit of it. And I think that we're going to, probably remain above these levels right here at the $7 or $8 level. But, when you have these parabolic moves up to the upside, and you have rallies of 240%, you should always expect, a drawdown. We're having a 28% drawdown from the highs after a 200% rally. I mean, that's not surprising, right? And this goes back to, I want James to kind of talk about this a little bit too, of what is the time horizon? How do you align your thesis, right? Because if you, oh man, I should have shared this, sorry. We have Hyperliquid Per that has moved up so much during this time. And then we have drawn back. Let me pull that back up that I just had. Oh. We're 28% from highs, and I think we're going to stay above this $7 or $8 level right here. But I think that this goes back to how are we stacking edges? And this goes back to the article that I wrote, which is on the Hyperliquid strategies thesis side, the gamma squeeze that I laid out. All of these factors are still stacking up. And what did I say? The gamma squeeze thesis is a cherry on top for what Per and Hyperliquid can actually do, because Hyperliquid is still producing cash flow every month. There's going to be a large player that comes in and says, oh, whatever, Arthur Hayes or whatever his name is, who is just trying to ride the wave of sentiment and not really understand the underlying utility of something. He's going to ride the wave and he's going to exit. And everyone who doesn't really understand the thesis is probably going to get flushed out with him, right? That's kind of to be expected. But when you go through the thesis that I've been laying out and understanding, okay, how does Per connect to this? How does it connect to the thesis? Remember, on June 26th, I mean, this is one of the reasons why I said in the next 60 days, not the next 5 days. In the next 60 days, I think there's going to be a gamma squeeze in Hyperliquid strategies, the stock, Per. One of the things is that it's getting added to the index on June 26th. And then on top of all of that, we begin to have all of these factors align with the Hyperliquid side, where it's continuing to generate more and more fees. You just had Coinbase back it. You just had all of these factors where market makers are not, US market makers are not allowed on the platform yet, but everyone recognizes the utility of Hyperliquid. And so if you go down to I'm actually on the website. Let me pull it up really fast. On the website right here, if you go to the gamma squeeze model, or the gamma squeeze article I published on May 30th, this lays out the entire thesis for stacking edges. And this, stacking edges is all about aligning time horizons with the credit cycle, with the macro bet, with the market microstructure, with positioning, with everything like that. And that's why I continue to hold my Per position. And I think that it's going to rally significantly higher. And we're still very much within the range, variance, and time horizons that I've been laying out. And I think that's really critical to understand on days like today. So James, what would you, how would you kind of begin to frame this for people as, we have a little bit of a pullback, we're having some changes, and people who probably didn't understand the thesis very well, they see some stuff in the timeline, they see some big account who is not actually that big, Arthur Hayes, sell his hype and they think, oh, maybe this is over. How would you kind of begin to frame that situation?
Yeah. Arthur Hayes is like a perfect example of like, if it walks like a duck, if it sounds like a duck, if it quacks like a duck, it's probably a duck. Like, if you ever watch his years, like, the guy's smart, okay? Like, I get it. He's a good writer. He has really great macro thoughts on the plumbing and everything, right? But if you watch consistently how he acts, he even says this. He's like blatantly obvious about that he is like an attention seeking, clout chasing firm that uses it to its advantage, right? So every single time he talks about a coin, he goes out there on his tour, he puts out a very large price target, gets everybody excited, and then at some point, 2 weeks, 2 months later, he says, oh, I exited my whole position because this and this, right? It's the same story over and over. He's never like really following through on these things, yet everybody hook, line, and sinker every time. And it goes back to you just not thinking from your own viewpoint and your own convictions. You're offloading the responsibility to this dude who wants to ski 6 months of the year, write some articles, and show a thing to you because he knows that you're going to pay for his new set of skis every year. You're the season pass holder, bro. It's you. You guys are paying for it. And like, if you don't realize that by now, like, what are you doing? Like, I like when Arthur's on my team, but I'm in it for another reason. I'm in hype for my own reasons. I like when he comes in and bull posts hype. I'm like, oh, cool. Like, Arthur's going to get more people in there. But it's never shocking to me when he's like, oh, yeah, I sold out at 75 because like we have a real test coming up with the Fed. And like, who cares, dude? Like, who fucking cares? The Zcash thing, I bet he got punished pretty hard there. I know he was in earlier, and I just, I like seeing the guy get a little bit of his own medicine. But I just think it comes back to like portfolio allocation, timing, having your own conviction, taking your own responsibility. And then this, like, you won't be typing Arthur Hayes in the chat box, and I've followed prey to all this stuff too. I'm by no means some sort of saint on this, but I just think it's something to watch out for, especially on days like this where you're just looking for reasons to blame. Just watch out. I don't even know what you were saying. I just got all Arthur Hayes angry there. So,
yeah. By the way, everyone, this stream is on YouTube.
Sorry. Yeah, I wanted to bring this up too. I don't know if
you guys can go on YouTube and just go to Capital Flows Research on YouTube, and you can go through that. But sorry, go ahead, James.
I was just going to show this. I was just looking up while you were talking. I want to make sure this is accurate. I had it pulled from Hyperliquid, but this is like the.
Can you zoom in?
How do I do that? Like,
like control scroll or.
Control scroll on
Control plus button. Control plus button.
Control plus on the actual screen share.
Yeah. Or is this a
this is ChatGPT? Yeah.
Yeah, it should be control or function plus, like the plus button.
I don't know. It doesn't matter too much.
Yeah.
I was looking at charting the PE of Hyperliquid with the circulating, which is in the blue line, and then like the FDV, which is in the green line. And you can see that we've had it come off. Like, to your point, we're basically selling off with fees going up, and the basically the price of it, like the PE, is coming back into like the lower bounds of valuation. So if you have like confidence in the bet, it's basically only improving over time. And somebody put in the comments, see, where is it? Volatility is great for fees, but we've seen these events taper off for fees. But like, yeah, like that's cool with me though. Like, it's like a buffer on the downside. And then as the network grows, like, you'll be seeing more HIP-3 additions. You'll have more action in the prediction markets, more of the fee accumulation from market makers paying for priority, all that stuff. Like as that network grows, especially if it comes into the US, like we have the upside normal growth, and then we have the downside plunge protection fee team, So to me, it's like a great situation.
Yeah, I mean, this goes back to risk reward. And I think this is just what's so difficult, by the way, not to get sidetracked or support. Well, we're not supporting anyone, but this is actually pretty funny when Hunter Biden is coming on the feed and talking about Hyperliquid. Like, what is happening?
Dude, it's like a stolen account, right? It's got to be, right? It's too out there.
It's
Like
too
it's too
based.
out. It's too good. Like I feel like it's an internet guy that figured out how to get in, and he's just playing the part super well.
Yeah, maybe. I don't know.
Come on, man. Don't get psyoped. Do you think Hunter Biden's like laying in his bed doing it? I don't know.
I don't think
You
so.
could
I don't
easily
really.
come
I
up with
mean,
these selfie photos and stuff on AI. Like I don't know. I don't buy it.
you know what? That's probably true. There's probably, they probably have like
Hyperliquid, dude. He's the previous president's son, Hyperliquid. Come on.
Hey, I'm with you. I'm with you. Well, I think that the going back to risk reward, my view has always been that you want to find things that are almost where the risk of losing capital is very, very low. And that's what most people are not thinking about, right? Like you and I, we think about how can I get a trade, get on size and protect my capital? How can I keep my seat at the table? And most people are thinking about how can I get lottery tickets and like have 100x? And we're thinking about that. But if you say like, hey, I'm risking, like whatever it might be, if I can find a bet where I have very limited risk, I can size up so much more in that. And so when I see Hyperliquid producing so much cash flow and having the amount of utility that it has and having more and more people on board onto the platform, not because of a self-fulfilling prophecy, but because of a value proposition, which is a key distinction. All of those things tell me about the risk on the downside that even if we, pull back and we chop around for a little bit and we, take all of these people who are euphoric and don't understand it and shake them out, then, as long as I'm on sides, then I'm happy. And I think this is just such a perfect example of and here, we can just look at this right here. We are up from the lows 200 and, we up 250% from the lows. And then, we're having a 20, let's be generous, and 24% pullback. 24% pullback in a 250% uptrend. So if you were, getting long Hyperliquid and per down here when we were talking about it, then and still, I mean, even from right here when we talked about the secondary risk reward, up 87%, and now we're having a 24% drawdown and we're still up 40. So, all of these factors are important to map. And I just think that this is a perfect example of, especially as we move into the weekend and people begin to say not sell indiscriminately and say like, okay, wait, how should we price these divergences? Oh, wait, the SpaceX IPO, how are we going to start pricing that on Hyperliquid? Is that going to be a big deal? Because, we have a lot of that's going to be a pretty significant thing on Hyperliquid itself, right? It doesn't matter as much about where this is going, whether it's going up or down. What matters is that volume is getting pushed through, and people are either hedging their risk or beginning to establish a position in the SpaceX IPO on Hyperliquid. And I think that's just going to continue to pull more and more capital in, generate more and more fees. And let me pull up this other dashboard for everyone to look at. Yeah, I mean, this is especially right now. Look at we're literally having revenue tick up right now. It's pretty significant rise right here in revenue, and Hyperliquid is selling off. So that just, I feel like, goes to show where we're at in the overall cycle. And then on top of that, you have Per, who is buying back a ton of stock, and they're they issued more shares when it was at a premium. They bought more Hyperliquid, and what I expect is that they're going to come in here and buy a bunch of stock at a discount, either with the cash that they have on hand or the credit facility. And so all of these oscillations, these short-term oscillations that have taken place, are all stacking up and compressing the risk for this thesis that I've been laying out. And so in many ways, I look at whatever is taking place and I ask, is this setting the stage for a larger rally, or is this beginning to test the trend and shake conviction in a way that could begin to start a bear move or a bear market? And when I look at everything right now, especially in the context of everything that we've covered on the streams over the last week, and again, if you have not understood all of these macro factors for everything go to the global carry trade article that I wrote yesterday for paid subscribers. Go through all of that, because if you're trying to understand macro liquidity and interest rates and how it impacts equities and things like that, read this article. It explains everything. So I think that's just going to be the key factor for as we move into this weekend, is understanding that macro context. Because what do you expect for S&P 500 has rallied so much, and people just think that it can't have one red down day, and they're just not thinking about the probabilities very well with what could drive this. Where's the downside going to be? The downside is probably going to be when the forward curve prices too many hikes. And let me actually pull that up really fast so you guys can have an idea of it. Give me 1 second. Let's see. Yeah, so right here in the forward curve for this year, we have 34 bips of hikes priced. So right here in the Z6 SOFR contract, if you look at that, we have basically one hike price for this year. And then into M6, which is going to be the middle of 2027, we have another hike priced. So 50 basis points of hikes. And so when you look at these two things, we have upside in terms of rates, basically, I would say capped at 50 bips of hikes as we move into that next FOMC meeting between now and the next. Let me get the exact date for the FOMC meeting, because I think that's going to be important. Next meeting is June 17th, and June 17th, we're priced basically at a 100% probability of a hold. So we're not going to hike or cut. And then the next meeting as well, July, also a hold. And then September, we're pricing a coin flip between a hold and a hike. So, we're not going to get a hike this upcoming meeting. We're almost certainly not going to get a hike in the next meeting in July. And so what you want to be watching is, how are we going to move into the June 17th meeting? Because what I would say is that we have, this non-farm payroll print. We could, marginally adjust into that in equities or whatever else it is. But once we hit that FOMC meeting, again, with first one with Kevin Warsh, you're like, especially if crude moves down between now and then, which I don't know if that'll happen or not, but if that happens, it'll even push things even more. Then what you're going to probably have is equities chop around a little bit into FOMC and move around here, and then as we hit FOMC, or it's actually not even that far, right? It's right here, June 17th. So, we could, move around here a little bit, unwind hedges, and then begin to rip back up, which would make perfect sense. Have everyone kind of jitter a little bit as you have rates reprice. And again, notice that everything is happening on the short end of the curve. Long end rates are basically sitting here because they're just waiting. They're waiting to see how the Fed is going to respond at this next meeting. And I think, we're approaching this level where everyone is going to wonder about how that takes place. And if we can unwind hedges, set more of a bottom in gold and silver that stays above these levels, and that will probably also help on a macro basis, Bitcoin, hyperliquid, and things like that from the macro side of things. Even if the macro side of things doesn't play out, the question will be, how much can the fundamentals accelerate even against the macro backdrop? Because remember, hyperliquid for a while rallied as equities sold off. Why is that? The macro backdrop was actually pushing equities down. Positioning was pushing equities down, but hyperliquid was rallying the entire time. Why is that? It's because the fundamentals of hyperliquid had more causal force to push the price up than the macro environment. Those are the best bets that you want, where the fundamentals are so strong that the macro regime doesn't even matter. And then the macro regime is kind of like a cherry on top that actually causes everything to amplify even further. And so what you want to do is stack all those edges, which is why, one of the things that I map, especially for equities, and we'll get into this right here. Pull this up. Hang on. Let's see if this works.
And for Andrew, for your question on hyperliquid, yes, it relies on fee generating volume, but that's kind of what we're talking about here. So just to quickly go over it, they make perps on crypto fees, perps on stock fees, spot fees, HIP-3 protocol share, builder code fees, auction fees, vault fees, and they're constantly listing more and more prediction market fees, which will be growing as well. And then you're getting more and more and more deployed assets into the ecosystem as more and more people join the ecosystem. And again, it's like the free roll idea of the optionality of America being able to kind of finally execute on this thing. I just think the growth there is going to be deflationary moving forward, even on low volatility stuff. Like, I would do a lot of my stuff here. And I just think that's kind of the whole point of what we're saying here is you could have hyperliquid outperform even in a period of lower volatility.
Yeah, I agree. I think that's going to be one of the key things to watch to see how it kind of plays out. James, when you look back on kind of over the last week and everything that we've been covering on stream, what's kind of the kind of picture that you've been building yourself as you move into the next, this month, where we have FOMC this month, we have some of these other questions around, Zcash, around crypto. I think this entire move in Zcash has been one of the things that has flushed positioning a bit. And I actually think that now, Zcash, all these other things have been the alternatives in the cycle, in a sense, to Bitcoin and ETH. And now what I believe is going to take place is that everyone's going to realize like hyperliquid is the only game in town. We already narrowed everything to hyperliquid and like some of these other names. And now it just feels like we're narrowing it even more. And that this next stage is going to be, well, maybe don't touch Zcash or some of these other things because we just don't know. But hyperliquid's kind of the only game in town. How do you think about that?
Yeah, I generally have been thinking that, but you'd be surprised how many crypto people want to invest in other things, no matter how many times we get slashed in the neck. But yeah, the Zcash thing was actually super interesting. I don't know if any of you really looked into it, but they hired just to quickly cover it, they hired an auditor to come in and see if he could find bugs and stuff like that. And he basically used Opus 4.8 and found a bug that basically showed that there was this vulnerability for 4 years. Now, the kicker here is we don't know if somebody took advantage of the vulnerability, but it was available for people for 4 years to do so if they figured it out, in which they could go effectively create Zcash out of thin air within this orchard protocol. And if they wanted to, it's like a first in, first out thing. So like they could just be selling the entire time. And there's some fun theories out there of like, everybody started shilling Zcash at the certain time. Why is that? Was there some sort of incentive for people to pay people so that they could exit their exploit? Now, I personally don't think the exploit like happened or whatever, because you probably would have seen a huge rush to the exit of this orchard protocol, like in big chunks or whatever. But I don't know. Either way, you're doing this to an ecosystem that is already timid and scared of all the fraud and all the terrible things that have happened to them, that like it's just hard to really be like, you know what, I'm just going to buy the dip here at Zcash, or I'm going to go buy other privacy coins, or what else could Opus 4.8 breach in the DeFi ecosystems. So really it's like, what do you got left, man? Like the one thing that's working, and then Bitcoin, I guess, if you're a Bitcoin believer, which a lot of people aren't, right? So I think like, all right, so going back to your question, like we've had this huge lockout trade in stocks, right? To the point where everybody's like, Jesus Christ, like this is ridiculous. And I fully expected, with VIX being so low, VVIX being so low, credit spreads being so tight, and everybody and their mother getting long calls and everything, we're going to have some sort of pullback that's so violent and fast that we're going to think we're letting the steam out, or the air out of the balloon. But in reality, to me, now that we're here, I'm just like, yeah, this is exactly kind of what we were thinking about and preparing for. Now in the crypto ecosystem, it's like heavily, like aggressively run down because of all that stuff going on. But even in the stock space, I'm like, all right, well, this is where I'm actually a little bit more comfortable buying some of the things that I want to be positioning in. So that's kind of how I see it. I see that as, and I think the like geopolitical risk at this point is so heavy on Trump and the administration that they have to do whatever they can to patch up as many of these holes that they've caused, or whatever you want to say, in the like broader kind of war situation and all that. So to me, I'm sitting here like, it doesn't look good, but it kind of feels right.
Yeah, I think that those are all like very fair points. I'm really interested because I think that I almost think that the entire crypto system and everything around it is pushing everyone back to the larger structural issues in macro. Because like, think about it, like in 2020, let's just say 2020 and 2021, 2022, crypto came out and it rallied so much because we had so much liquidity in the system. And Web3 seemed like a possible reality. And then everyone's like, oh no, like Web3 doesn't work, right? Like no one cares about that. And everyone tossed Web3. And then we have another cycle where everyone's saying like, okay, well, dollar devaluation, Bitcoin is this hedge, it's digital gold. And that makes sense. And I think I think there's a shake to that idea a little bit, but I think that continues to, that'll continue to persist, but it's getting shaken a little bit. But now I think everything is converging to push everyone back to the actual system of the dollar. Because what did Hyperliquid finally tap into? It tapped into saying, hey, let's create derivatives and a very high value product around US dollars and US traditional assets, instead of collateralizing everything with like Bitcoin as collateral, like all of the lending protocols like Aave or any of these other ones did. And so it's almost like every single thing is coming back to macro. And now it's all about, do you understand the larger macro picture and what is taking place there? That's what I think is so great about this entire thesis, because everything is converging in a large way around it, right?
Excuse me 1 second. I got
You're good. So in the macro environment overall, I'm just walk people through price action a little bit more. We have equities down on the day, primarily driven by interest rates. And we talked about this on stream that bonds pulling back a little bit is likely going to drag on equities a little bit, but equities will likely mean revert back up. You have the dollar down.
Sorry about that.
The dollar. You're good. Dollar up on the day, and then you have crude down marginally. What'll be very interesting is to see if crude moves down as interest rates move up. That would be kind of the ultimate kind of positioning squeeze that confuses people because of this time lag and how inflation goes through the economy. And then you have gold and silver down a little bit. And then I just think if we go through FOMC and then begin to rip some of these hedges, it is going to be so intense for the rally that takes place. So I think we have so many factors stacking up where when I look at a day like today, I'm just thinking, wow, the opportunities are beginning to stack up again for another kind of execution on the risk side.
Yeah, I like it. I think the timing is maybe a little bit. I don't know. I'm not sure yet on the timing of it all, but
Sure.
Going into the weekend, it's kind of interesting here. I like timing wise. I actually like it more to the upside on the weekend, just because of like how the past 10, 12, 16 weeks have gone. Like it always seems like fading the move into the weekend has been the proper play. And just like the market's been able to kind of look through a lot of the problems. And I just think like it feels like we're going to be gapping up from wherever we finished today. So like, but then I don't know how it shakes out. If today was Monday, then I would be like, oof, like this is, this doesn't look like a super solid start to the week, and this could like continue to roll over itself. But it's almost like we're getting a little bit of a break going into the weekend. But that's all just like me bullshitting, So
Right.
We'll see.
Totally. Had a question on the Oracle side, and we'll actually be doing an entire stream next week, Wednesday, explaining that a little bit more. And James and I will be talking about that and breaking down the thesis a bit more. Overall, our view continues to be that it's skewed to the upside and that the earnings are going to be a pretty significant pivot point. And I think the biggest pivot point will be if we get a timeline for when cash flows from CapEx begin to come to fruition, it will cause Oracle to diverge from the entire sector, maybe similar to SanDisk, and begin to just absolutely rip, which again, I've made notes for paid subscribers. Go to the chat. You can see kind of the more specific expressions and views that I talked about in there. So if you want that, go to the website and go to the chat section. But that's what I would say about Oracle. Actually, on Snow, I actually think that it's very interesting to see Snow, rallying like this, and now we're kind of selling off. But I would not be surprised to see Snow begin to, lock into this entire AI theme a bit more and begin to push higher and take out this IPO high sometime soon. So that's something I'm watching really closely as well, in terms of Snowflake and their development after earnings, where this earnings gap up right here was pretty significant, and I think that could have marked a pretty significant inflection point for the company.
Yeah, really interesting. Last question here, just or last couple or whatever, but okay, it's not going to happen, but let's just play a game. What if they did actually decide to raise rates June 17th? Kevin Warsh comes in after all of this, right? And raises rates in his first move. What's the play, Flows? What's the reaction going to look like? And how does this change your thinking about stuff?
If they do a surprise rate hike on June 17th, you will have the market sell off. You'll probably have bonds sell off a bit, but you'll have, basically the curve flatten more as they're hiking into long end rates basically being flat like they are today. And you'll probably have like a lot of leverage in the system get flushed out for maybe a week and a half or 2 weeks. But if they hike then, and then if they hiked, you would probably price 2 to 3 more hikes on the curve within moments of that happening. And then that would probably begin to put so much pressure on inflation that you would have bonds probably over the next 4 weeks after that begin to make a bottom, because rates would begin to be restrictive because they actually took real rates and pushed them higher. That would probably drag on equities a little bit in the short term. And then, but the thing is, like, all of these CapEx flows don't care about up 25 bips or down 25 bips for the Fed, right? And all the equity market cares about right now is how aggressive earnings are versus what's going to happen. And the interest rate side is moving around positioning a little bit, but the amount of change taking place is so extreme that it is actually a safety net to keep liquidity in the market. So that's what I would say about that type of thing. And one of the things that I'll also say about that is that the market is pricing 100% probability of a pause, and we just went through NFP. So you have to recognize that the FOMC is they're always looking at the forward curve every single day. I mean, like, Powell wakes up every day, or it's not Powell anymore, but Powell, when he woke up every day, he would look at his Bloomberg terminal and he would look and say, what is the forward curve pricing? How is it adjusting to these changes in inflation, things like that? Should I say something hawkish, or should I not speak, or what should I do? And so their inaction also sends a signal. Historically speaking, unless there is something really, really crazy happening, which means cross-asset vol is rising, unless there's something really crazy happening, they never do a surprise hike or cut. Never. Like, they never do that historically. And if they did, you would actually have less order in financial markets, higher volatility, which would actually be self-defeating, because it would make inflation risk actually increase a little bit on the upside and downside, where people are saying, like, well, we already have enough uncertainty with inflation. Now it doesn't seem like the Fed even knows themselves. What are we even going to do here? Right. And so that's how I think about those types of scenarios and what's likely. And if they actually did it, they would likely leak the news weeks before, or, a week before, or something like that.
Yeah, it's like that would be such sending a message, but it would cause just so much. Like, I just assume the last thing they would want to do is throw that monkey wrench into that situation.
Oh, yeah, totally.
I mean, it would send quite the statement of, like, too late, Jerome, was too late. This is how you're supposed to deal with it. But, like, that's not on the table at the moment.
Yeah.
If you guys wanted to go see more about the Oracle thesis, maybe you could quickly pull up your capitalflowsresearch.com. You could go find the thesis there. You could also go to either of our YouTube channels and watch the Oracle video that I posted. It's like a big red thumbnail talking through kind of Larry Ellison and how you're stacking not only an interesting bet in software, but you're stacking that on top of one of the most legendary business operators in history. So I would suggest watching that, reading through his thesis, especially since we're getting pullbacks across the board here. If it's something you want to start thinking about putting into your portfolio, you got to start thinking about how you're going to do that. What's the sizing? What's my risk management? Is this something I believe in? Do I understand the thesis? Or am I going to come back here on stream next time it's down 5% and rage at us because, it's not up? So stuff to think about there.
Yeah, if you go to the Capital Flows YouTube channel, you can see the video that James just did here, where he laid out our thesis. And then if you just click and go to the actual website, you can see everything the video that James just did here. You can go through where he laid out our thesis. And then if you go to the Gamma Squeeze article, I linked all the Oracle things that I did here as well. So you can see my article on AI, next biggest bet on Oracle, the playbook for that, the model to map it, and you just go to May 30th and it'll all be linked there. So May 30th article, go there. You can see all that breakdown. And then we're working on some stuff, guys. We'll have some other stuff kind of cooking for you guys. And then we'll have that Oracle live stream next week. And we're working on the next big bets. So it'll all come together.
Yeah. So make sure you guys show up every day. Like you said, there's going to be some big changes coming, hopefully. And I think it's going to be really great for everybody who decides to come here and spend their time. Also, it is Oracle earnings day next Wednesday too. So just that's another chapter to put into your story, whether or not you want to be positioning into earnings or post earnings, right? That's always something interesting to bring into the mix. And I was seeing lots of new names out there. So, and of course we got our strongholds like Alfie and others, but nice to see you guys stopping by. We're going to, bring the most in-depth macro foundational work here, and then also include, mindset, execution, tactical stuff that you can implement day to day. And I don't think many people are doing that out there. So hopefully you guys are enjoying it.
Awesome. All right, everyone. Well, we are going to wrap the stream today. I have some other research pieces I'm working on for paid subscribers that I'll be sending out. And if you guys have any questions, you can always come in the comment section, go to the Substack chat, anything like that. I'm always trying to answer things there. And we will, the next live stream is going to be the Oracle one next week. So that'll be Wednesday morning. And then Monday and Tuesday, I'm going to have some special reports for paid subscribers that I'll be working on. So I won't be able to do the live stream, but we'll have that big live stream for Oracle next Wednesday. And then and then after that, we'll have live streams the rest of the week as well on a daily basis. So we'll continue jamming on those, and we will catch you guys next week on the Oracle live stream.